Get straight to our market panel. Joining us now, Calvasina from RBC Capital Markets and Phil Camporeale from JP Morgan Asset Management. Great to have you both here. Phil, you're on set. I'm going to start with you. You got a real bumpy start to the month, but historically September is always the weakest month. Yep. You got a 10-year Treasury yield at 3.75 right now. How does this position us for the rest of the year? Yeah,
honestly, Morgan, we've been, as asset allocators, we've been waiting 2 years for this exact environment. So what do I mean by that, right? Jerome Powell, the time has come for policy to adjust. I'm telling you, we've been waiting 2 years for that because 2 years ago it was the economy needs to go through some pain in order for us to achieve our dual mandate. So this is why this all matters. We were hoping for the soft landing to start to become a reality. Hope is not an investment strategy, and the reality is that it's here. So we believe a soft landing is a 2% GDP growth number. Atlanta Fed GDP now is at 2% right now, and about a 3% inflation number. It's 5% nominal growth. That sounds nice. That allows us to be overweight equity in this environment. But at the end of the day, what we really like as multi-asset investors is that finally fixed income could be the defense in the portfolio. Because remember, we went through years where we didn't really know how to protect ourselves because inflation was the risk. Inflation is going way back now behind the labor market. Labor market is becoming in focus. So if we're wrong on our lean into risk, both in equities and in high yield bonds, we think we can protect ourselves with core bonds. Now, that's a really important dynamic for us as we head into the second half of the year. But make no mistake about it, we only have a 20% probability of recession over the next 12 months. A consequence of a soft landing is a slowing in growth and a renormalization of the labor market. But we're not ready to make that jump to recession or weakness. We're not even saying weakness. We're just saying normalization. I think that's the right word.
Lori, how do you see this market right now? I mean, we had a weaker than expected JOLTS number this morning. Are we at a key inflection for the economy? And if so, what does that mean for stocks and other asset classes?
So, look, I agree with a lot of what Phil just said. I like the word normalization very much. And I think we have to go back and remember that the Fed did want to see a cooling off of the labor market. And look, I think that we have had, just an extraordinary recovery. We're getting to this point, right, where we're fretting over minutia. And I think that what's happening is the market is taking sort of the worst case scenario on a day like today and interpreting it as potential reality. But that's something that makes sense when you've got extended valuations, when you've got extended positioning. If you look at AAII net bullishness, we're basically back to one standard deviation above the long-term average last week, and that's a level that's proved tricky for equities to navigate in the short term. So expensive valuations, full positioning, full sentiment, you're going to see a market that doesn't react well to a little bit of bad news. I think in general, if you zoom out, again, I go back to Phil's word of normalization. When I go through earnings call transcripts, when we look at really what companies are saying, we see things that are consistent with a softening in the growth rate, a cooling in the labor market, but not an economy that's on the precipice. And so I think we have to sort of look through this short-term noise and stay focused on the bigger picture.
So, Phil, if you've got this defense capability in the portfolio now that you didn't have before, what kind of risks are you then willing to take in this market environment? Is it a different level or different type of risk or same?
Yeah, John, I would almost make the case that uncertainty is lower now. I know we're all talking about, oh my goodness, is the Fed going to go 50 or 25? But the risk that we're really talking about here is go be overweight equities, 3/4 of our overweight. So in a 60-40 type portfolio, John, we're talking about a 68% allocation to stocks. So that's an 8% overweight with about 3/4 of that in the U.S. It remains our biggest, our highest confidence view is the U.S., right? The soft landing view, the no recession environment. And then akin to that on the fixed income side, are corporate bonds. Like high yield is a no recession asset class where we're getting this quiet yield, very, very similar to what we can get in the equity market with lower volatility. I think what we're seeing over the past few weeks, though, is this is a new chapter now. Like March of 2022, Fed starts raising rates, a lot of volatility. November of last year, we've seen enough evidence to pause our interest rate cycle. We saw the equity market and the bond market have incredible months in November. I think that's what we're trying to deal with now is, should you be making the leap to that worst case scenario of recession, or is this a necessary consequence for the Fed to be able to start cutting rates? And I think it's the latter for us, John, which again leads us into a cycle extension with easier financial conditions, 5% nominal growth. I'm raising my hand for that in portfolio.